back. We're joined by a few experts now to help us understand what this will mean for banks now going forward. We have with us Parag Jariwala of Religare. Parag, first reaction, RBI has of course given into the demand that sustainable portion of the debt be treated as standard, but here we have the catch, provisioning has been increased.
So if you look at what the guidelines is, that if the loan facility is considered as non-performing asset and you are implementing S4A, then you can have an option of treating Part A as a standard if you have 50% provision on Part B or 25% on aggregate. So as compared to this, the earlier guideline was saying that non-performing asset will stay as non-performing asset. So in fact, I think this is positive for lenders because you have an option to have 50% provision on Part B and upgrade the assets to a standard category.
Yet they're higher than the earlier provisions. If I recall correctly, RBI had said that 20% of the total debt or 40% of the unsustainable is the amount of provision you had to make, but that has now been increased.
No, that's on the standard asset, if I remember correctly. But on non-performing assets, see, as per earlier guidelines, you have to, assets needs to have their existing category. So if it is a standard, it will remain standard. If it is a restructure, it will remain a restructure. If it is a non-performing, it will remain a non-performing. But here you have an option to upgrade your non-performing assets to a standard assets if you have 50% provision on Part B. So I think if I have to recheck the entire earlier guidelines, but if I'm right, then I think this is mildly positive for all banks under consideration.
What do you have to say about the changes that RBI said it has made to the unsustainable portion of the debt? It says, and I'll read it out to you, lenders can upgrade Part B to standard category and reverse the associated enhanced provisions after 1 year of satisfactory performance of the sustainable portion of the loans. What will this mean for bankers going forward?
See, it just says that basically if your sustainable portion, if it is performing up to the mark, then after 1 year of satisfactory performance, you can upgrade the Part B of loan to a standard category as well. So I think Part B would be your equities, preference shares, and etc., where you have to have a lot of provisions and etc. But if your standard, if your Part A is performing well, then you have an option even to upgrade Part B, so that provision which you probably make for the next 1 year when the S4A scheme is getting implemented, that can be reversed. So, in 1 year down the line, you will have lesser provisions, or you probably, provision write-backs and all those stuff.
Well, Parag, I just want to add that the notification goes on to say, since you're talking about, the way provisioning will be done, it goes on to say that in all cases, the required M2M provisions on Part B instruments must be maintained at all times. So there are certain caveats that are in place. But a basic question, does this seem to be a far more watered down version of the S4A? In which case, do you expect it to meet with greater success? Because correct me if I'm wrong, I think HCC is the only real big account that's gone under S4A till now, right?
Exactly, and if you speak to a couple of companies which wanted to get into S4A scheme and etc., were expecting that, the 50% sustainable portion will become off to 40, 30, and they were expecting some restructuring can even take place in the sustainable portion. So I think the expectation from the companies were very high. I think that has definitely not come in, and what we have seen is as you said rightly, it's a watered down version of what everybody was expecting. So I think in that sense, it's not a kind of a win-win situation for the borrowers under question.
I think not just a watered down version of what the bankers were expecting, it is a watered down version of the scheme itself is what I think Surabhi was trying to suggest. And I want to ask you this, is this one relaxation enough to kickstart many of those S4A cases that banks have been considering for some time? Many of the steel companies that have been in the news, including the likes of Bhushan Steel, say, and Alok Industries, would they now qualify, or is this not enough for those companies to really be brought under S4A now?
See, I think the biggest worry for all these companies was that, they don't have a cash flow which can support 50% of their debt. So that is where, I think the scheme is not able to kickstart itself, because if your current cash flow is not able to sustain 50% of the debt, that means you cannot go to step A, step B, or step C. So I think there is no changes on those sides. So what will happen is, probably, we will see that out of 15, 20 companies which are waiting for S4A scheme, maybe 2 or 3 may qualify. But I don't see, sea change in terms of the companies which are eligible for S4A scheme.
So would you say then, Urjit Patel, as he said, he'd be firm but pragmatic, has been more firm and less pragmatic?
I mean, it's so difficult to comment, but I think it is more realistic, yeah. I mean, I don't see a situation why should a company be given a third chance. If you look at CDR was a first chance, then SDR, then now S4A, which is a third chance, if you cannot sustain 50% of your debt.
In fact, we're joined by a very veteran banker, Mr. RK Bansal from IDBI Bank. Mr. Bansal, thank you for joining us. Your first reaction to, compared to what the banks had requested the RBI in terms of the changes to be made to S4A to what now the RBI has said. One, of course, it has allowed is, if you would have seen the guidelines, for the sustainable portion of the debt to be classified as standard if an approval plan is in place, one, and B, if the provisioning upfront by the lenders is higher, which is 50% of the amount held in Part B, which is unsustainable, or 25% of the aggregate debt?
Yeah, I'd say a good clarification, frankly speaking. One was that earlier also you were saying that it should not apply to only project loan. So that clarification they have given by way of mail-post clarification. Now the issue is that standard can be treated Part A and Part B, both can be treated as standard, but subject to the provisions. The only issue was coming up that during the period when the resolution plan is being worked out, whether you can keep it standard. Otherwise, the standard case, even under earlier guidelines, if you were using S4A, it was standard only.
Right, but here I think it very clearly says until and unless the resolution plan is in place, you cannot revert the account, which is an NPA, to a standard account, if I'm not wrong. Do you think now, some of the conditions that you had put forward, some of the bankers had asked for more restructuring to be allowed in the sustainable portion. Is that a big setback? Would you again, approach the Reserve Bank of India to consider some of those conditions?
No, I agree that some of the things which bankers have been asking Reserve Bank, especially keeping in view the fact that many of these loans are having some slightly short-term repayment schedule, so that that can be changed. But I think that is becoming an issue because a lot of amounts are overdue as on that date when we talk of S4A. So it becomes difficult unless we give some reschedulement. That has still not come.
So, Mr. Bansal, in a nutshell, this new version which is talking about allowing both Part A and Part B to be treated as standard under certain conditions, of course, to what extent will it really help kickstart this scheme? We were speaking to an analyst just earlier, and he pointed out that certain conditions relating to working capital requirements, they are still intact. So, sir, do you expect more companies to fall under the S4A ambit because of this notification that's out this evening?
No, one good thing which they have allowed is that basically this part, the correction amendment, what they are doing under the you can treat as standard, that will help us in restructuring some of the NPA cases. Up to now, there was a confusion that if the case is NPA, whether it can be classified as standard. So that was an issue. Now that is almost clear that once it is even if it is NPA, you can classify both the part as standard. So that is one good thing which has happened. But I think the clarification on that other part which you are pointing out on working capital or the overdues or reschedulement, I think that was one expectation we had. So that has not come. So I feel it will be marginal effect on the S4A.